of return. It can go up, it can go down. So that is standard deviation. कभी आपने कॉलेज में कॉमर्स में स्टैट्स वगैरह पढ़ा हो तो पहले हम वेरिएंस निकालते थे और वहां से स्टैंडर्ड डेविएशन ड्राइव आउट होता था. बट ओवर हियर यू डोंट हैव टू get bothered onto the part how to calculate it. In every fact sheet there are standard deviation, and on the dashboard of volatility coach we have complete data for the mutual funds. Lower the standard deviation, better it is. Another risk which is associated for market is beta. When it comes to beta, मैं आपको एग्जांपल पहले हिंदी में देती हूँ फिर इंग्लिश में दूंगी. कोविड आया, मार्केट नीचे गिर गई. मार्केट नीचे गिर गई तो शेयर्स भी नीचे गिरने लगे. भाई ना शेयर्स ने ऐसा कोई लॉस किया था, ऐसा तो नहीं था ऑल ऑफ अ सडन टाटा मोटर लॉस में आ गया या ऑल ऑफ अ सडन रिलायंस लॉस में आ गया. एक शेयर जो 2000 का था वो 850 का बिकने लग गया बिकॉज ऑफ द मार्केट मोमेंटम. मार्केट की दिशा जिस तरफ है उसके हिसाब से मेरा शेयर कितना गिरेगा या बढ़ेगा उसको हम बीटा कहते हैं. बीटा को मार्केट रिस्क भी बोलते हैं और बीटा को वोलेटिलिटी रिस्क भी बोलते हैं. आई स्पीक इन इंग्लिश अगेन सर. बीटा को मार्केट रिस्क भी बोलते हैं, बीटा को वोलेटिलिटी रिस्क भी बोलते हैं. हम इसे कम नहीं कर सकते. आप बीटा को कम नहीं कर सकते, बीटा इंटैक्ट रहेगा ही रहेगा. फाइन. जितने भी इंडाइसेस हैं, आई होप ऑल ऑफ यू अंडरस्टैंड इंडेक्स. निफ्टी, सेंसेक्स, बैंक निफ्टी, ये जितने भी इंडेक्स हैं इनका बीटा 1 होता है. इनको इसी तरह से बनाया जाता है कि इनका बीटा 1 होता है. नाउ आई एम स्पीकिंग इन इंग्लिश अगेन. व्हेन इट कम्स टू बीटा, बीटा इज नोन एज मार्केट रिस्क, इट इज नोन एज वोलेटिलिटी रिस्क. द बेस्ट एग्जांपल आई कैन कोट ओवर हियर इज द फॉल ऑफ कोविड. बिकॉज there was a negative news, there was a global lockdown, market was falling. Along with that, every stock was falling. Some were falling more, some were falling less. This relationship with the market movement is measured by beta. All the indices, whether it is Nifty, whether it is Sensex, whether it is Bank Nifty, their beta is 1. Their formation is such that their beta is 1. We cannot reduce beta. We can only average beta. हम डाइवर्सिफिकेशन के जरिए बीटा को रिड्यूस नहीं कर सकते, सिर्फ बीटा एवरेज होता है. सो इक्विटी में दो तरह के रिस्क हैं, स्टैंडर्ड डेविएशन एंड बीटा. स्टैंडर्ड डेविएशन इज वेरिएबिलिटी रिस्क, दैट हाउ मच इट वेरीज फ्रॉम एक्सपेक्टेड रेट ऑफ रिटर्न. व्हेन इट कम्स टू बीटा, बीटा इज वोलेटिलिटी रिस्क, दैट हाउ मच योर स्टॉक और फोलियो इज वॉलेटाइल as compared to market. Fine. I can reduce standard deviation with the help of diversification, but I cannot reduce beta with the help of diversification. Only I can average. Standard deviation अलग अलग जगह पैसा डालने से कम हो जाता है, जिसे हम इंग्लिश में डाइवर्सिफिकेशन बोलते हैं. मगर जब हम बीटा की बात करते हैं तो बीटा डाइवर्सिफाई नहीं होता. आप किसी भी शेयर में पैसा डालिए, बीटा होगा ही होगा. तो बीटा जो है एवरेज हो जाता है. अब बहुत सारी रेशोज हैं. पहली रेशो की बात करें और उससे पहले इस रेशो की बात करें उससे पहले भी मैं आपको एक कॉन्सेप्ट बता देती हूँ. एक सेकंड दीजिए, आई विल राइट इट डाउन. सॉरी. रिस्क फ्री रेट. करंटली लेट्स से द रिस्क फ्री रेट इज 6%. अगर मैं नहीं रिस्क लूं, मुझे गवर्नमेंट गारंटीड रिटर्न चाहिए, तो ये 6% तो मेरे हाथ में है. इफ आई डोंट टेक रिस्क, दिस गवर्नमेंट रेट इज इन माय हैंड, दैट इज रिस्क फ्री रेट. बट व्हाट हैपन, निशांत सेज, अरे नहीं मैम, आई वांट टू टेक रिस्क, आई वांट टू इन्वेस्ट फॉर माय रिटायरमेंट, तो इससे तो मेरा कुछ होगा नहीं. सो आई वांट टू टेक रिस्क एंड आई वांट टू इन्वेस्ट इन अ वॉलेटाइल एसेट क्लास, दैट इज इक्विटी. तो निशांत ने वॉलेटाइल एसेट क्लास में इन्वेस्ट किया. Obviously, Nishant will expect higher than risk-free rate. ठीक है ना. Obviously, अगर आप रिस्क ले रहे हो तो एक डायलॉग था ना, रिस्क है तो इश्क है. तो उस रिस्क से इश्क किया है निशांत ने या किसी ने भी, क्लाइंट ने या मैंने. सो वी एक्सपेक्ट कि भाई रिस्क प्रीमियम, रिस्क फ्री रेट से ऊपर रिटर्न आए. सो लेट्स से निशांत फोलियो जनरेटेड 15% return. So 15 minus 6 is 9% is risk premium. निशांत ने रिस्क लिया, निशांत ने मेरे कहने से इक्विटी म्यूचुअल फंड खरीदा. नाउ निशांत इज एबल टू अर्न 15% रिटर्न, एंड नाउ that 9% which he have earned extra above the risk-free rate is known as risk premium. Is known as risk premium. So जब भी हम रिटर्न बाइफिकेशन में एक कैलकुलेशन में लिखते हैं तो हम उसको बाइफरकेट करते हैं कि भाई उसमें कितना रिस्क लेता तो मुझे कितना एक्स्ट्रा आया. तो वो कैलकुलेट करने के लिए हम देखते हैं कि भाई एक्सपेक्टेड रेट ऑफ रिटर्न रियलाइज रेट ऑफ रिटर्न माइनस योर रिस्क फ्री रेट इज योर रिस्क प्रीमियम. दैट रिस्क लेने से मेरे को कितना रिटर्न बेहतर आया. हायर द रिस्क प्रीमियम बेटर इट इज. अब मान लो स्टैंडर्ड डेविएशन तो है 4%, मगर रिटर्न मेरे पास आया 2%. भाई रिस्क प्रीमियम का 6 + 2 8% का रिटर्न आया, तो फिर रिस्क लेके फायदा नहीं हुआ ना. रिस्क तो ज्यादा था, रिटर्न कम आया. इफ आई एम टेकिंग हायर रिस्क आई एक्सपेक्ट हायर रिटर्न. ये तो एक सिंपल सा फिनोमेना है. सो व्हेनेवर वी राइट द रिटर्न वी बाइफरकेट देम in risk free rate plus risk premium. Why risk premium? क्योंकि I'm parking my asset in a volatile asset class. I'm seeking higher return than that of risk free rate. क्योंकि मैं volatile asset class में पैसे निवेश कर रही हूँ तो मेरी रिटर्न एक्सपेक्टेशन हायर होगी जो रिस्क फ्री से ज्यादा होगी. तो उस पार्ट को हम रिस्क प्रीमियम कहते हैं. किसी को कुछ नहीं समझ आए प्लीज यूज द चैट बॉक्स. आप चैट पे लिख दीजिए, मैम रिपीट कर दीजिए. अगर किसी को लगता है कि आई एम गोइंग फास्ट प्लीज लिख दीजिए आई विल गो स्लो. मैं अपने फ्लो से चल रही हूँ और कोई टर्म मैं बोल जाऊं विच यू आर नॉट एबल टू अंडरस्टैंड, अगेन टाइप इन द चैट बॉक्स, अनम्यूट योरसेल्फ इफ यू आर अलाउड टू. आपको मैं दोबारा समझाऊंगी. रिपीट. परफेक्टली फाइन. रवि दोबारा रिपीट करती हूँ, ध्यान से सुनिएगा बच्चे. रवि रिस्क फ्री रेट हम किसे कहते हैं? राजे हम रिस्क फ्री रेट उसे कहते हैं जो हमें गवर्नमेंट दे रही है. गवर्नमेंट का रिस्क फ्री रेट है क्योंकि गवर्नमेंट तो डिफॉल्ट होती नहीं. ठीक है, बशर्ते बांग्लादेश सॉरी नीचे श्रीलंका या पाकिस्तान गवर्नमेंट हो तो बात अलग है. रिस्क फ्री रेट 6% है. यानी रवि अगर रिस्क नहीं लेता और उसे एक फिक्स सिक्योर रिटर्न चाहिए तो ये रिटर्न तो उसके हाथ में पड़ा है. रवि कहता है नहीं श्वेता मैम आई विल इन्वेस्ट इन इक्विटी. अब भाई रवि आप इक्विटी में इन्वेस्ट करोगे तो रिस्क है, वोलाटिलिटी रिस्क है, वेरिएबिलिटी रिस्क है, बीटा का रिस्क है, स्टैंडर्ड डेविएशन का रिस्क है. यू एक्सपेक्ट अ हायर रेट ऑफ रिटर्न व्हिच इज एब्सोल्युटली फाइन कि भाई मैंने रिस्क लिया है तो मैं हायर रेट ऑफ रिटर्न एक्सपेक्ट कर रहा हूं. सो रवि गॉट 15% रिटर्न फ्रॉम हिज फोलियो. ठीक है जी. तो 15 - 6 this 9% is risk premium. बच्चा रिस्क प्रीमियम आपने रिस्क लिया तो वो 6% के ऊपर आपको जितना भी रिटर्न आया दैट इज योर रिस्क प्रीमियम. एज यू हैव टेकन risk, you have invested in a volatile asset class, you are able to generate 15% return, out of which 6% was the risk free rate comparatively return. So over and above 6% is your risk premium. So this is 9% which is your risk premium. रवि जी अभी क्लियर है? टाइप इन द चैट बॉक्स, आंसर करें या दोबारा समझाऊं? यस परफेक्टली फाइन. ठीक है सर, आई एम स्पीकिंग इन इंग्लिश, आई एम स्पीकिंग इन हिंदी. आई होप यू आर कंफर्टेबल. हाँ, I'm repeating all the things in Hindi, I'm repeating all the things in English. Now, when it comes to Sharpe ratio, Sharpe says, well, पहले तो S for Sharpe, S for standard deviation. Though you don't have to go through the formula as you're using Volatility Coach dashboard, but still you should, I'll be writing certain formulas. Yes, I'm speaking in English, I'm speaking in Hindi both, sir. Fine. Haan. So, when it comes to Sharpe ratio, it says RP minus RF, the complete divided by SD, that is standard deviation. So what they are exactly doing is, let's say Ravi folio is 15% return, risk-free rate is 6%, and standard deviation is 3. That means 9 divided by 3 is 3%. रवि के फोलियो पे 15% का रिटर्न है, 6% रिस्क फ्री है, ठीक है, 6% रिस्क फ्री है, मैंने उसे स्टैंडर्ड डेविएशन से डिवाइड किया, तो 9 divided by 3, that means as Ravi have taken the risk of standard deviation. Abhishek, I am perfectly fine if everybody understand English. Fine. So RP minus RF divided by standard deviation, 15 minus 6 divided by 3. So 15 minus 6. Bapi Kumar, please mute करिए अपने आप को. 15 minus 6 is 9% is the risk premium. When I divide 9 by 3, I get 3%. That means for every single percent of deviation, my folio is able to generate 3% return. So higher the Sharpe, better it is. Higher the Sharpe, better it is. So Sharpe ratio says, just allow me to mute everyone.
I'm muting it.
Higher the Sharpe, better it is. For every single unit of risk, what return you're able to generate, that is known as Sharpe ratio, additional rate of return earned by your portfolio above the risk-free rate as compared to the risk taken on that. And Sharpe just considered only one risk in the folio, that is standard deviation. So generally when we do the comparison with Sharpe, let's say I'm taking 2 flexi cap, both have given 15% return. But when I compare it with Sharpe along with the standard deviation, A standard deviation is 3%, B standard deviation is 5%. Obviously, A is better because A is able to generate higher return as compared to B in the comparison of risk, because they are able to generate 15%, but the risk of A was 3%, but the risk of B was 5%. Fine. So Sharpe, better, higher it is, better for you. If it is lower, it is not good. Any question, any query on Sharpe ratio, use the chat box and ask. Fine. Any question, any query, use the chat box. You don't have to remember the formula, you have to remember the concept. So basically in Sharpe ratio, we take numerator, denominator. So whatsoever you write above the line is numerator and whatsoever you write below the line is denominator. So over here, Sharpe considered only risk, that is standard deviation. Now next. When it comes to Jensen ratio or alpha, this ratio is basically realized minus expectation. What was my expectation and what actually I got in hand? The difference of that is known as alpha, or that is known as Jensen ratio. I expected 15%, but I was able to get only 12%. So obviously it is not good because I'm not able to generate the return as per my expectation. My expectation was 15%. My folio was able to generate 20%. Obviously, it is good because it is able to beat my expectation. और फिर हम कहते हैं कि कुछ ज़्यादा मिले तो अच्छा लगता है. That is the concept. Now, from where they drive out this expectation? Expectation में तो मुझे रवि कहेगा, अरे मैम, my client is expecting 50% return. We are not here with to dream with open eyes. Fine, we talk on ground realities. So in that very case, this expectation arrives from a capital asset pricing model. So I'll write down the formula just to explain you the concept, but again I'm saying you don't have to remember. So it is RF plus RM minus RF multiplied by beta. So let's say RF is 6%. Return from the stock market is 20%. That is Sensex, Nifty. The return is 20%. I subtract the risk-free rate and then I multiply it with the beta. Let's say beta is 0.75. 0.75. Please listen to me very carefully. This formula is for expected rate of return. Expected rate of return as per capital asset pricing model. Fine. Expected rate of return, I take RF as 6%. Return from the market is 20%. Beta is 0.5. This means that the risk premium of the market, risk premium of the market is equal to 20 minus 6, that is 14%. So the equity market have given 14% higher return as compared to risk-free rate. So now risk premium of the folio or the stock. So I'll multiply 14 with beta. Now what is beta? Beta is variable volatility risk. So let's say my stock beta is 1. That means if market moves 10%, my stock will move 10%. If market will go minus 5%, my stock will go minus 5%. Over here it is 0.5. That means if market goes 1% up, my folio will go 0.75% up or 0.75% down, depending upon to the moment of the market. So if markets have given a return of 14%, what my folio should give the return? If my folio's beta is 0.75. So 14 multiplied by 0.75 is 10.5. So this is the risk premium of the folio. So what should be my expected rate of return? 6 plus 10.5, that is 16.5. That is 16.5. Fine. So this how expected rate of return is calculated, and alpha is calculated with the help of RP minus expected rate of return. So over in this case, if my folio have given 20% return, and as per CAPM, my expectation was 16.5, my alpha is positive, which is a good sign. Higher it is, better for you. It need to be positive. I'll explain again. Capital asset pricing model is a theory which drive out the expected rate of return in correlation to the beta of the particular stock or folio with the market. They basically calculate the risk premium of the market, then they multiply it with the beta to calculate the risk premium of the stock, and then they add again the risk-free rate, which help us to drive out the expected rate of return. Once we are able to drive out expected rate of return, realized minus expectation is your alpha. Higher it is, better for you. Any question, any query on this? Any question, any query on this? No, perfectly fine, Chetan. Thank you. Now, the next ratio is Mr. Narayanan, when it comes to fact sheets, on certain fact sheets I've seen alpha, on certain fact sheet I haven't seen alpha, but on the dashboard you will see alpha for 1 year, 2 year, 3 year, 5 year. That I'll show you once I'll finish up with my slides. Fine. So you can use the volatility coach dashboard where you can use all these things without even calculating. Here I'm using the formula just to make you understand the concept. Over there, once the concept is there, you don't have to remember the formula, you have to apply it. Like in simple, when it comes to Sharpe ratio, we simply considered it within the context of standard deviation. As per single standard deviation, what risk premium has been generated by my folio is known as Sharpe ratio. When it comes to alpha, alpha is what return I have get extra above the expected rate of return. And when I'm driving out expected rate of return, I'm using a theoretical formula of CAPM, that is capital asset pricing model, which drive out expected rate of return in context with beta. In context with beta, that how much the return has been generated as compared to the relationship mentioned between the stock and index in the form of beta. Fine. Higher the Jensen, better it is. Now come trainer. Trainer sir came and he said, if a market is fully diversified, if a folio is fully diversified, then I don't need standard deviation, because we say we can reduce the standard deviation with the help of diversification. We can reduce the standard deviation with the help of diversification. So now in that very case, he says in denominator, instead of taking standard deviation, I am considering beta. So it is RP minus RF divided by beta. Life of maths is very simple. BODMAS, bracket on, division, multiplication, subtraction, that is. So let's say RP is 15%, RF is 6%, beta is 0.75. So it is 9 divided by 0.75. Let me calculate. 9 divided by 0.75 is 12%. So for every single beta, my folio have generated 12% risk premium, and higher the trainer, better it is. Higher the trainer, better it is. Trainer ratio, take the only risk in the folio is beta, because they says in a fully diversified folio, the only risk which is associated is systematic risk or market risk, and in that very case, higher the ratio, better it is. So S for Sharpe, S for standard deviation. Nowadays, the customer listen good lot of news from YouTube and everything. So if they talk about Sharpe ratio, you should be able to make him understand the concept. I don't know whether you have ever came across, but many people whom I in touch, yeah, one of my IFA, he said, ma'am, he was asking about Sharpe ratio. He was asking about trainer ratio. You have heard in some YouTube video, and now he's asking me. Rohit sir, when it comes to these ratios don't change, don't see a remarkable difference. We generally see them on, as these ratios are from equity only. So we look forward from the longer term perspective. Yes, near time, if there is a correction, like I'll take an example of IT stocks. IT stocks were in correction. So Tata Digital India Fund, ICICI Technology Fund, where last 5 years their CAGR return was, I was able to see it as 35%, but because of last 2 years, the IT stocks are down. Same ICICI Technology, last 5 years CAGR is 24%. So it again depends which sector or which type of fund you're looking forward to. If you're looking in a sectorial fund, and if that particular sector is into correction, that yes, might you see good lot of change in those ratios, because there is a downtrend into the stock or there's an uptrend into the stocks. If there's a correction in small cap, let's say when the markets were all-time high prior to COVID, we used to call it as a market where only the front lines were moving, but there was not much momentum in the small cap and mid cap. So despite I was seeing markets were making new high, my small cap folio was not performing because it was correcting. So it completely depends that what sector, whether you're looking for a large cap. In large cap, unless and until there is no good downtrend aspect is there, will not see much of the changes that way. Satyamurthy Sahab, you need to check the past. You need to analyze the performance in the past. Then we bet on to the fund manager, and there are lot many other things. What is the folio? What is the AUM of the folio? What is the percentage of expenses there? So on past performance only, like, look, if I scored in 10th 90%, then only my school will allow me to sit in, take the commerce or take science. That was the base. Similarly, past performance become the basis. Then we even see the fund manager also, and then we look forward to invest. So this is basically a base for us to move further, that how much grass was greener in the past time. Though we say past performance never guaranteed the future one, but if a fund manager is consistently performing very well, so I'm ready to bet on that. But for consistent performance, again, I need to see this data. So RP minus RF divided by beta. Any question on trainer ratio? Any question on trainer ratio? Sort time ratio. As I said, there are certain ratios which only take downside risk of standard deviation. They say if it goes up, there is no risk, because if I'm getting extra, it is not a risk for me. So again, it is RP minus RF divided by downward standard deviation. RP minus RF. So both in Sharpe, in trainer, in sort time, the numerator remains the same, RP minus RF. When we do RP minus RF, basically we are calculating the risk premium of that particular stock or particular folio. Divided by, in Sharpe it was standard deviation, in trainer it was beta, and in sort time ratio it is downward risk. That if it goes down, how much return, how much risk premium I am be able to get. Again, higher the ratio, better it is. Sort time ratio. Normally, when you will look forward in the fact sheet, you'll be able to see the ratios like Sharpe and trainer. These are the two common ratios which are available in almost every fact sheet. Now, when it comes to information ratio, information, it is a matrix for measuring. Okay, Chetan, I'll give you an example of which one. अभी इंफॉर्मेशन रेशियो समझाने तो दो, फिर बताती हूँ. एग्जाम्पल से पहले समझा तो दो बच्चा. It is a metric for measuring how a portfolio asset fares in regards to benchmark compared to its volatility return. It is a ratio portfolio above the return of the benchmark, usually an index, just with the index which we are comparing. When it comes to index, when the mutual fund compare the index, they take TRI index. So if you see a word in the fact sheet, it is TRI index and it is PRI index. Earlier it was PRI. Now they take it from 2018 onward, they are taking TRI. So total return indexes. So let me explain this and then we'll come to information ratio. Let's say in my benchmark, there is one stock which is valued 100. So I have an index which have one stock, which is practically not possible, just for an example. Now, after a year, it is 120. After a year, it is 120. Now, as per PRI, price return index, the return from the index is 20%. But as per TRI, it will consider dividend also. Let's say the dividend declared by the company is 2 rupees. So now it is 22 rupees at the year end. So it is 22%. So in mutual funds, when the comparison is done with the benchmark, it is done with the TRI. So if anybody or your client asks you, "Arey sir, ye TRI kya likha hua?" It is total return index and PRI is price return index. Information ratio measure a portfolio manager ability to generate excess return relative as compared to benchmark. So here we look forward for the tracking error aspect, that how much we are able to track up the index. So let's say portfolio have generated a return of 12%, while benchmark have generated a return of 8%. My portfolio have generated a return of 12%. Let's say I'll write it down. Portfolio return 12%. Index return is 8%. So, and the tracking error, I hope all of you understand tracking error. Tracking error is how well you are tracking up the index. So the tracking error is 5%. So my IR, information ratio, will be 12 minus 8 divided by 5. That comes to 0.8. higher it is, better for you. Lower it is, not good for you. The more my folio is able to beat the benchmark, it is good for you. Fine. So investor often refer IRR when eyeing to invest in mutual funds. So basically, information ratio is more used for the ETF or for the index fund. ETF is exchange traded funds and index funds. So generally for them, we use it more. Any question, any query on information ratio? Any question, any query on information ratio? Please feel free to ask. Ask as many questions as you can. Okay. R square. It denotes the percentage by which the movement of price of a portfolio can be explained by the movement of price of the underlying benchmark. It ranges from 0 to 100, with 100 indicating that a fund is highly correlated with the index to track. Fine. A fund that have R square between 85 to 100 is considered to be good. So let's say my folios, a mutual fund, one mutual fund is there, that folios return is R square is 90%. 90. That means if the underlying will move 10%, it will move 9%. Fine. So higher it is, it actually calculate the correlation. Higher it is, better for you. Higher it is, better for you. If it is 70 or less, R square is considered poor. Again, you need to see it is for equity and analyze it and then go ahead with. Again, I'm repeating, you need to understand the concept. So this is R square. Expense ratio. Lower it is, better for you. आजकल तो game ही expense का है. Now they're betting on TER, total expense ratios. Fine. So better, lower it is, better for you. And you have to see that direct and regular का भी एक expense पे question आता है. So many of the client often ask, अरे sir, direct is having the lower expense ratio, why I should invest with you? Yes, Chetan, obviously nowadays the commissions have cut and lower it is not good for you, but you need to answer your client on this aspect also. Nowadays, you know, we say अर्धज्ञानी सबसे खतरनाक होता है. Lot many people listen good lot of things from Facebook, YouTube, Instagram, and how they interpret it, it's completely depend upon their understanding. Fine. Let's say an influencer is talking about some equity sectorial fund, and he is answering to someone who is young of age, 25 of age, who is ready to take the risk, and a 55-year-old listening that and take the decision of investing in sectorial fund, it becomes haywire. So very first thing, the client comes and says to you that direct have a lower expense ratio as compared to regular. So why I should invest for you with you? Simply, I am providing you with the knowledgeable service in a sea of 44 AMC, with the sea of more than 2000 product. You are not aware which product is suitable for you or not. And generally, if you see those DIY concept, do it yourself wala concept doesn't work in finance. So you need to bet on your knowledge, on your services, and on the how you actually connect with them and what kind of services you are providing. So you need to bet on the quality of your services. Yes, Harshit, simple, but होता नहीं है ना बच्चा. People वो हम मारवाड़ी में कहते हैं कि पीठ पक्की छाती कच्ची. सो पीठ पक्की छाती कच्ची का मतलब ये होता है पीठ पीछे कुछ भी ले लो, सामने कुछ ले रहे हो तो वो हाय तौबा मचाने लग जाएगा. सो दैट इज द एस्पेक्ट. वो पीठ कैसे पक्की है कि भाई डायरेक्ट ले लिया, वहां नीचे जा रहा है चलेगा क्योंकि मैं खुद अपनी मर्जी से कुएं में कूदा हूँ. छाती कच्ची ऐसे है कि जब मुझे हर्षित ने कहा कि मेरे से ले लो, अरे डायरेक्ट और रेगुलर में तो 0.75 का परसेंट का डिफरेंस है. रिसेंटली आई कंडक्टेड IIP and over there was a aged senior citizen. He was 75 plus. He said, mutual fund agent don't give me the passbacks, you tell me what they earn. Mega very first thing, sir, whatsoever you invest, it completely get invested fully into your account. And one more thing, nowadays this stamp duty get deducted. So please convey to your clients that this stamp duty is not coming in your pocket, neither it is going in the pocket of AMC. It is basically levied by government. Lot many people in the IIP, like conduct IIP across India, lot many people have this query, अरे मैम वो stamp duty करता है, वो तो मेरे agent का commission है. No, no. Be clear. Don't think that customer knows this is stamp duty. Be vocal and tell him, boss, this is applied by the government. Fine. So it's very important. So I answered him, sir, whatsoever you invest, the percentage amount which is getting deducted is stamp duty. So your complete amount get invested. So practically when first time I'm giving you the services, I'm not getting anything. And whatsoever trail which I'm getting as a mutual fund agent is a part and parcel of the complete expense aspect. So need to be very vocal on your quality of service and on yourself. Be a brand for you. As simple as that. Abhi, let me first ask any question, any query. I'll run the slide again. You want me to explain anything again, please tell me. So first over here, I talked about two risks which is associated in the folio of equity, standard deviation and beta. When it comes to index and ETF, we take tracking error, that how efficiently I'm tracking the index. That is tracking error. So all of you are able to understand standard deviation, beta and tracking error. Give me a thumbs up or yes or no in the chat box, or you want me to explain it again. You can reduce the standard deviation with the help of diversification, but you cannot reduce beta. With diversification, we can only average it. Done? Perfect. Again, which one to again? Tama, Ravi, whether you want me to explain you standard deviation again or whether you want to explain it. Okay, Debajit, I'll explain standard deviation. Perfectly fine. Debajit, a import firm is there and the news comes that if somebody is importing, fine, he's bringing the product from outside country to India, and now the US dollars have increased. The price of the US dollar have increased. And now because of this, there will be a variability to that particular stock because that particular stock is getting affected from that news of dollar appreciation. This variability is known as standard deviation, that how much your return will vary. Yes, how much your return will vary from your expectation. So that is standard deviation. If I pour everything in auto sector and auto sector went down, then it is a risk. So rather than investing everything in auto sector, I invest in different sector. I reduce my risk with the help of diversification, and that is measured by standard deviation. Ravi, when it comes to tracking error in index fund, let's say it is a Nifty index fund or a Nifty ETF. Now, a passive fund manager just have to do the copy paste. So copy paste Nifty 50 weightage as it is in the folio. If Reliance is weighted 10%, in my folio it should be 10%. If ONGC is 4%, in my folio it should be 4%. So practically I'm doing a copy paste. So if I'm doing a copy paste of the folio, my folio should generate the equal return as compared to the Nifty, because I'm replicating a Nifty. But Nifty generated a return of 12%. My folio generated a return of 11%. It was 1% less. That is known as tracking error, that the fund manager was not able to track efficiently the index while he was managing the folio. So lower the tracking error, better it is for the folio. Ravi, is it clear? Tracking error. And Debajit sir, is it clear? Standard deviation. You need to, yes, fine. And Ravi, clear, bacha? Ma'am, there's also sector fund. There are also. So Paul sir, standard deviation of the sectorial fund is calculated in the fact sheet only. That is defined in the fact sheet. It is there into the dashboard. Ravi, tracking error clear? I've explained tracking error. I'm asking, aapko clear ho gaya Ravi, tracking error? Are you able to understand what I explained you in tracking error? Yes or no? Okay, I'm answering. Okay. Paul, sir, sectorial fund, the standard deviation will be there. They have calculated, will not get into the calculation part. Yes, Rajiv, it is there onto the dashboard. Perfectly fine. Thank you. Sharpe ratio considered the risk of variability, that is standard deviation. On per single unit of standard deviation, what risk premium I got? Higher the Sharpe, better it is. When it comes to Jensen, it is realized minus expectation. What was my expectation as with the correlation to beta and the market? And what was my realized rate of return? This is also there on the dashboard. Trainer ratio, RP minus RF, it just simply considered the risk of beta. It says in a fully diversified folio, the risk which is more prominent is beta. Harshit, let me finish this. I'll answer this later on because this is not correlated with this ratios. When it comes to investment objective, in investment objective, it is defined whether the fund manager is going at what style, whether it is a value fund, whether it is a growth fund, and even there is a box which is given, which define where all they are investing. Gadkar sir, beta is generally when I answer, when I teach, I call everyone beta or bacha. So beta, acha, you're asking beta. Fine. Okay, fine. Sorry, beta. Beta is volatility risk. That I explained you with the help of standard deviation. Beta is volatility risk. All the index have beta 1. There I've quoted you with the example in a COVID, when the markets were falling because there was a global lockdown and we were in an uncertain situation. Every stock, goddamn, it was large cap, mid cap, small cap, penny stock, every stock have fallen. Despite none of the company have made losses, this moment of the stock with the market fall is measured by beta. All the indices, that is Nifty, Bank Nifty, Fin Nifty, have beta 1. They are formed in such a manner. Every individual stock have different beta. So do every equity mutual fund folio have different beta. Beta is volatility risk. We cannot reduce beta because it will be part and parcel of our folio. We call it as systematic risk. We can only average beta. We cannot reduce beta. So in trainer ratio, it says when it is a fully diversified folio, the only risk which is associated is beta. Paul sir, when I was explaining this Jensen measure, I have written the formula that how the expected rate of return is calculated as the formula of CAPM, expected rate of return ka formula. It is RF plus RM minus RF multiplied by beta. So first we calculate the risk premium of the market. We multiply it with the beta of the folio. We calculate the risk premium of the folio, and then we add the risk-free rate of return. That's how we drive out expected rate of return in alpha. And once we get the expectation, we subtract it from the realized rate of return. So this formula is basically from CAPM model. Clear hai, sir? Okay. Now, short-time ratio only considered downwards ratio. Gaurav will come on that. I'll be coming to dashboard. We'll come on that. Short-time ratio just only considered the downward standard deviation. We don't see the upward standard deviation. So it is RP minus RF divided by standard downward standard deviation. Information ratio is precisely more relevant to the index fund and ETF, where we compare it with the return of index and we divide it with the tracking error. I've explained you the tracking error, how efficiently you're tracking the index. When it comes to R square, it is basically movement of your folio with the movement of the underlying benchmark. Higher it is, better for you. So basically a standardized aspect, if it is above 70, it is good. If it is below 70, we need to reconsider with the other aspects. Expense ratio, it is the cost which is being incurred by the company. Lower it is, better for the fund. Lower the expense, higher the return to the investors. Now, let's go to the website and let me show you this. And Nishant, you are there?
Yes, ma'am, I'm here.
हाँ प्लीज मेरे को जरा ये टेक्निकली ये फिर से मैं ये लॉग आउट हो गई हूँ, तो प्लीज हेल्प मी आउट ऑन दिस. अभी मुझे
हाँ, आप एक बार क्लोज कर दीजिए इनकॉग्निटो और वापस से इनकॉग्निटो खोल लीजिए. इट विल ओपन.
इसमें नहीं खुलेगा.
एक बार ट्राई कर लीजिए, मोर और लेस खुल जाना चाहिए इसमें.
ओके नहीं, क्या बताया तुमने? ऑल्ट शिफ्ट कंट्रोल ऑल्ट
कंट्रोल शिफ्ट एन.
आई
एन.
एन. ओके
Some problem is there. I don't know why this logout happens.
अच्छा, वो एक बार लॉग आउट हो गया फिर वो दोबारा लॉग इन भी नहीं कर रहा मुझे वहां से.
हाँ, यही कुछ प्रॉब्लम हो रहा है. I'll just talk to the developer, but for now I think
हाँ
it will
वो
log in.
देख लेते हैं, कोई दिक्कत नहीं. टेक्नोलॉजी है, तंग करती रहती है मगर फायदे भी देती है. ठीक है ना, कभी कभी तो तंग करेगी. Mutual fund analysis. You click on mutual fund analysis. So you can select the very first thing. You can select the category. Which category you want to go ahead with. Let's say we'll click on. Let's say large cap fund, index fund. For index fund, the ratio which we'll be using is information ratio. Fine. You can use all, but more relevant aspect is as we are tracking the index, we go ahead with information ratio. Then you can change over here and you can select what type of ratio you want to go ahead, and you can see we have data of 2022, 2021, 20, 19, 18, 17, 16, and the comparative returns is given for 1 month, 6 month, 10 year. And then I lower down, you can see over here. एक second लीजिए.
मैम सिंपली स्क्रॉल करेंगे तो हो जाएगा डबल.
हाँ हो जाएगा, वही कर रहे थे. So you can see over here information for 1 year, 3 year, 5 year, 7 year. I can click on, if I'm betting on equity, I look forward for the longer term. That is completely my view. I look forward for the longer term rate of return, because I look forward for the consistent performer very first thing. I look forward that who have survived from last 10, 12 years, 20 long years. Fine. So lot many people even keep a good track on the fund managers also. So over here you can see Sharpe, short time, standard deviation, beta, trainer, alpha, information ratio. So there are information ratio, there is R square also. Fine. So might be this particular I need to take. So these things you can select. Fine. Let's say now we'll click on another category. We'll not click on index. We'll click on. There is a problem on my mouse. No, pad where I'm clicking. Just wait. I'm not able to deselect it. I'll select this.
You can select another category and then deselect the index of.
बच्चा वो मेरे ना इस माउस पैड पे दिक्कत हो रही है. I don't know what's happening. ये देखिए खोल रहा है, राइट क्लिक कर रहा है, लेफ्ट क्लिक नहीं दे रहा है मेरे को. I don't know. What you can do, Nishant? Can you open and I'll show you?
I'll do one thing. I'll share my own screen.
You do that.
All right.
एक second. I'll stop sharing the screen and use reshare the screen. That will be better.
Just ma'am, give me a moment. Which one to select?
Let's say we'll click on large cap. large cap, and we can select all. We can see the ratios. Sharpe, Jensen, all the ratios, all three. Basically, more what I use as a comparison is Sharpe, Sortine, Sharpe ratio, trainer ratio. And the more you analyze them, the more visible it is. For a diversified fund, I look forward for trainer ratio more as compared to Sharpe, because when it comes to a diversified fund, the risk of variability is less as compared to volatility. So if it is a fully diversified folio, I look forward for the trainer ratio as compared to Sharpe or Sortine ratio. Yes, this CAPM, that is alpha. Alpha I always check, because that actually help you to understand what is the realization and what was the expectation, the difference in both. So bacha, you can apply, you can show them the ratios, and you can tell them how to apply 1 year, 5 year. So you can go to this dashboard and you can select what all long term ratios you look forward, and you can edit this dashboard completely. So you can select any one of them. So let's say over here it is large cap fund. I look forward for the Sharpe for longer term. I look forward for the trainer for longer term, and I look forward for the alpha for longer term. 5-year works, 7-year works, that completely on you. Now you can do the comparison with the help of this, that which one is performing good or which one is not performing good as compared to the returns also, which is being generated or given by the folio. Right? Any question, any query on this? You need to read it out. You need to understand. Merely seeing the dashboard, you'll be not able to analyze anything unless and until you'll put the effort to understand the concept and then apply it. Fine. Otherwise, it merely will be the number, and you'll be selecting the numbers which are showing higher or lesser, but you need to go ahead with the logical aspects, and you need to read the concepts clearly. Any question, any query over here? Nishant, if there is no query and no questions.
Ma'am, anything you want to show from the dashboard right now, except for what you have already said?
For mutual fund, these aspects is there. Rest to dashboard explain हो ही रहा होगा ना इन लोगों को, बाकी सब
जी.
चीजें तो.
जी.
हाँ.
If anybody has any questions.
Yes, yes, sir. Any question?
Madam, as per my knowledge, standard deviation should be low, like 7 or 8. But currently, all schemes standard deviations is more than 10. So is it high risk, right?
Ravi, when it comes to equity, rarely I have seen any of the folio having standard deviation of 7 or 8. They are higher standard deviation. And when it is higher, you need to seek the return also. If as per the higher standard deviation, if you are not able to generate that sort of return, then you should revisit, you should revalue your folio and exit from that scheme and go to another scheme.
Okay, thank you.
And have a longer term, broader vision, Ravi. Many times what happens is, for a shorter time frame, maybe because of correction or something, 1 month or 2-3 months, something is not performing. That doesn't mean you should exit. And let's say I'll take an example of technology only. As I said, ki last 2 years, the technology is not performing well. And let's say I have parked your fund in information technology. Ravi will say, "Arey, 2 saal mein nothing have been done." But I need to make you understand, Ravi, that you have invested it from the longer term perspective. That is, let's say the financial goal aligned to it is your retirement. And Ravi is right now 30 of age. I don't know your age, Ravi, so I'm just taking an example. And now Ravi is still 30 years away. And technology is something, because of technology, I'm talking to you, all of you. So technology is something without which we cannot survive. So merely some smaller time frame correction will, I should not judge the aspect of exiting from that folio. So please, just not with the ratio, you need to understand the economical aspect at micro and macro level and in the global economy also. if there is a recession or a slowdown in US, yes, it will affect us. So we are living in a global village where we are interrelated to each other, and something happens to them affect us also. So please go ahead and be aware of what is happening in the surrounding also. Any other question, any other query?
Madam, I mean, among large cap category, as per your criteria, which one is better? Yeah, let me show.
Acha. As per, okay.
Your knowledge.
निशांत इसको इस पे आप ले जाओ. So first we'll see it onto the basis of alpha. On the basis of alpha, which one is performing well? तो बच्चा alpha है ना, alpha 5 year. हाँ. So it is ascending. Go ahead with descending. So alpha is good with the Edelweiss. Fine. So very first thing, alpha is good onto the Edelweiss basis, and then I'll see the expense part, and then I'll see the trainer part, and then I will look forward for the standard deviation. So expense of expense wise चला जा बच्चे. Expense, हाँ. Ascending, descending, descending आ गया. So expense of Baroda Edelweiss is on 2.58. Fine. So now you're able to see it is 2.58. Alpha is high among the masses, but when it comes to expense, it is the 5th or 6th one. Fine. Now I look forward for the individual risk also. How much is the standard deviation? How much is the beta? And then we analyze. Only on the basis of one ratio, I can't conclude that this fund is performing well. Who might be he's able to generate a higher alpha, but if it having the higher expenses, then what of use? So you need to go ahead with one base and then analyze with other and then correlate and then come back to the conclusion.
Okay.
It's been how long, Ravi, into this industry?
From last 5 years, madam.
Okay. 5 साल की सरकार हो गई मतलब.
Yeah.
Okay.
Why, madam?
Huh?
Why are you asking like this?
No, in general, I'm asking because nowadays lot many people are coming into mutual fund industry. So I generally ask people, it's been how long into this industry? Because
Okay.
last 2 years, I think I have trained more than 200 plus batches for NISM 5A. So
Okay.
that you have more competition now in the market.
Thank you, madam. Thank you.
So you have more competition, more and more people are selling. So more you should bet onto the quality of your knowledge. That is the thing. So pick one thing and not just one. First you analyze, okay, on the basis of alpha, this is good. But now I have to correlate with the expense. I have to correlate with the beta, and then I have to come up with the conclusion. You know, that's the reason I write down the formula and explained you the formula so that you can actually analyze just by not merely looking at the dashboard. You should able to explain the client also, okay, this is the ratio and this is the logic behind it. Any other question, any other query?
Ma'am, I think we are done for the day. There are no more questions.
Fine, Nishant, thank you.
Yeah. So thank you to all the participants for attending this beautiful session. Shweta ma'am, thank you for conducting this beautiful session.
Thank you.
Always a pleasure. Thank you.
Thank you. Thank you, all of you. Thank you.